Hello and welcome to another video on competition law, videos where we try to visualize some of the core concepts of competition regulation. In the previous video on pricing, we included the effect of costs on pricing. However, we did not go deeper into what costs we were referring to or what types of costs actually exist. In this video, we will introduce a number of types of costs and explain where and how they are used. These costs will be broken down into two sections: general types of costs relevant to competition law and cost standards that are specific to competition law. The first question you might ask yourself is, why do I need to have a basic understanding of economics, pricing, costs, market structure? I'm an attorney, and if I need help with economics, I refer the matter back to an economist. Basically, competition law is about regulating companies' competitive behavior, which is linked to the objectives of companies, which to a large extent is to optimize their profit under the given market structure to the benefit of their shareholders. Of course, it has relevance across agreements and cartels, abuse of dominance issues, merger control, and market definition. Thus, a basic understanding is therefore required when dealing with these matters. But don't panic. All the provisions leave plenty of room for legal arguments and interpretation, and thus lots of money for attorneys. You might recall the table and chart on this slide, which was also used in the video on pricing. Both the table and the chart are fully correct, but now we must be more precise about the costs that we were referring to. In this example, the costs are the variable cost of producing the product. That are the costs that varies with the size of the volume produced. When we talk about the cost, the baseline is total cost, consisting of all costs associated with a product. Moreover, a variation of this is average total cost, expressing the unit costs. However, some of these total costs are variable, while others are fixed. Total cost and average total cost can be broken down to variable and fixed costs, and expressed in terms of units, average variable costs, and average fixed costs. In the example provided earlier, variable costs are shown as one. However, a company has normally a number of variable costs that all feed into the company's variable costs. These variable costs could all be different elements used to produce a car, including aluminum, paint, plastic. These variable costs per unit are often just shown as variable costs without specifying what type of variable cost it is. If costs are not labeled, for example, variable cost, you can do so based on whether a particular cost is varying with the size of the volume produced. Variable costs, or rather average variable costs, have been used in competition law cases such as AXO and Wanadu. In AXO, variable costs were defined as those which vary depending on the quantities produced, and thus separated from fixed costs defined as those which remain constant regardless of the qualities produced. However, the competition law cost standards, AAC, and LRAIC, seem to have become more predominant the last decade, but more on this later in this video. The opposite of variable costs, which are those costs that vary with the size of volume produced, is of course fixed costs. Fixed costs are those costs that do not vary with the size of production, as already indicated. Although fixed costs do not vary with the size of production, they are nevertheless sometimes shown per unit. For example, if fixed costs are 600 and 10 units are produced, the fixed cost per unit is 60. But if only 2 units are sold, then fixed cost per unit is 300. A company often has a number of fixed costs, depending on the line of business and sector. This could be rent for the building, a 4G license, costs of running an IT department, and the salary for the CEO. In the chart presented earlier, we only included variable costs fixed at 40 when optimizing the pricing. In this, we excluded any fixed cost. So, do fixed costs not matter? We must remember that fixed costs do matter, but just not when calculating the optimal price and thus short-time price optimizing. However, for a company to survive in the market, it must be able to cover all costs, including fixed costs. This means that in the example, what we denoted profit was more correctly the contribution margin. That is the margin that is left when variable costs are subtracted from turnover. The contribution margin must be able to cover all fixed costs. In our example, the optimal price was 70, which generated a turnover of 2,100 and variable costs of 1,200 and a contribution margin of 900. Thus, this contribution margin of 900 must be enough to cover all additional fixed costs and hopefully leave a profit for the owners. The inclusion of profit can be illustrated with a chart showing that the blue contribution margin peaks at 900 with a price of 70, but that fixed costs are 600 must be subtracted. If the company has long-term fixed costs exceeding 900, it will go bankrupt and leave the market. This is actually a consequence of the competitive pressure, as it is supposed that the other companies in that market are able to cover all costs at the price of 70. The chart shows that the contribution margin is insufficient to cover fixed costs of 1,000. The same can be illustrated in terms of total costs, that is, variable costs plus fixed costs. As is illustrated by the chart, profit is maximized where the difference between the red turnover line and the blue total cost line is at its largest. Total costs, or rather average total costs, have been used in competition law cases such as AXO. In AXO, total costs were defined as fixed costs plus variable costs. However, the competition law cost standards, AAC and LRAIC, seem to have become more predominant in the last decade. But more on this later in this video. However, at least in the long run, there are only very few costs that are truly fixed. Most fixed costs are actually semi-fixed costs and are costs that are fixed but only for an interval of units. Some examples of such costs are number of employees. Now, we must keep in mind that a company may increase or decrease its workforce, although there might be a slack time of some months. Another example would be number of PCs. A company, you see, can quickly buy additional PCs or sell its used PCs. Also, size of fleet of cars or vessels. Just as with PCs, a company can buy more cars or vessels or sell the used ones. However, a car or a PC can be delivered more quickly than a vessel. And of course, a machine in a factory is the last example. New machines can be ordered and existing machines can be sold. Furthermore, the production interval in which these costs are fixed also vary. The just mentioned production intervals for which a cost is fixed leads us to the concept of capacity constraints. For instance, the capacity of an employee is 10 units per month. Another example, the capacity of a machine in the production is 5 units per month and 500 units in a lifetime. Or the capacity of a vessel may be 10,000 containers per load and 50,000 hours of sailing. Thus, the capacity constraints might be multidimensional. If a company wishes to produce more, it will have to buy more capacity, either in the form of employing extra people or in the form of an additional machine. The discussion about variable cost and semi-fixed costs leads us to the concept of marginal costs. The marginal cost is the cost of producing one additional unit. That is when a company has already produced 5 units and considers to produce one additional. Often, marginal costs are equal to variable cost, which is illustrated by the chart by the blue variable cost column and the green marginal cost column being equally high for most units produced. However, due to the existing of capacity constraints and to the need to invest, for example, new machines if a company wishes to produce beyond its existing capacity, marginal costs may be higher than variable costs. Assuming that a machine has a capacity of 5 units and that a machine costs 600, then for the first unit and for the 6th unit, marginal costs are much higher than variable costs, as fixed costs are 600 incurred. So the machine is a semi-fixed cost. To be even more precise with respect to the economics of optimal pricing, what economists really want to know is not the variable costs of a company, but its marginal costs. Furthermore, marginal costs may also be higher than average variable costs if average variable costs are increasing with an increase in production. For example, due to an increase in demand, or lower if a rebate is achieved on a marginal unit. In reality, there are very few costs that are 100% fixed. Economists often say that in the long run, all costs are variable. as they can be adapted to changes in the activity level of the company. For instance, the rent for buildings mentioned above as an example of a fixed cost can be reduced in the long run by moving to another property if turnover decreases. The same applies to the IT department, as also the cost for this department can be reduced in the long run by laying off people. Even the salary of the CEO can be adapted. Having now introduced both the concept of marginal costs and the concept of capacity constraints, this leads to the concept of incremental costs. As you might recall from one of the previous slides, marginal costs were the cost of producing one additional unit. And if producing the 71st unit required the employment of one extra person, because the existing employees had reached their capacity limit, the cost of the 71st unit could be rather high. In many real-life situations, the question is not whether to produce one additional unit, but the cost of producing an additional number of units. An example of incremental cost could be the cost of supplying a new consumer who would like to quote of 10 units. In such a situation, the relevant cost would be the incremental cost of producing these additional 10 units. That is all the additional costs of producing unit 71 to unit 80. If these costs are 10 times 40 equals 400 plus additional fixed costs of 100, then the incremental cost would be amounting to 500. The average incremental cost can then be calculated as 500 divided by 10, which equals 50. Another type of cost that you might have heard about are sunk costs. Sunk costs are costs that a company has already paid out, which it cannot be refunded. Sunk costs are irrelevant in decision making. However, if a sunk cost has been financed with a loan and the company cannot pay back the loan, including interest with the contribution margin earned, the company will have to leave the market. This can be explained with a simple example. Let's take a look at a mobile operator that just paid $100 million for a 4G license. The $100 million are probably financed by a loan from a bank. Over the coming years, the company will have to generate enough contribution margin to pay all fixed costs and then to pay off the loan. If it cannot do so, it will go bankrupt. Another type of cost that you might have heard about are opportunity costs. Opportunity costs represent the benefits an individual, investor, or business misses out on when choosing one alternative over another. Presume, for example, you decide not to complete your law program, but instead to study economics. If a lawyer can expect to earn $120,000 a year and an economist can expect to earn $60,000 a year, then the opportunity cost of studying economics instead of law is $120,000. Financial reports do not show opportunity cost, but companies and individuals do take this into consideration constantly when confronted with opportunities and thus have to make decisions. As a final cost concept, we will shortly touch upon common and shared costs. Real common costs are general, not attributable to specific products or services. Typical examples of common costs are the salary to the CEO and to the CFO, rent for buildings, and headquarter expenses. Shared costs are a form of common cost, but it is sometimes used for common costs that are specific for some, but not all products, and thus not avoidable by terminating only one of these products. Shared costs are also referred to as joint costs. After this introduction to the most important cost concepts, we can now move on to the cost standards that are specific to competition law. The cost standards specific to competition law are the following: average avoidable costs, or AAC, and long-run average incremental cost, LRAIC. In contrast to the cost concept already presented, they are unique legal concepts and will be often unknown to economists or even accountants. Average avoidable costs, AAC, is used to assess whether a dominant company under Article 102 is pricing below its cost. Average avoidable costs are defined in the Commission's Notice on Abuse of Dominance. Thus, AAC are all the costs that a company could have avoided, that are the additional costs by not producing a specific number of units, or for example, 20% of its sales of product A. This is illustrated with the house to the right on the slide. It is important to note that a number of costs incurred to produce the product are not covered by AAC. This is primarily fixed costs or semi-fixed costs and real common costs. This definition makes sense when assessing whether a dominant company is abusing its dominant position by pricing below costs, as it tells us whether the company incurs a loss when deciding to sell some units at a low price. That is, the company would have been better off by not producing these units. In that respect, the Commission's notice is also referring to the company making a sacrifice. The idea is that when a company takes a decision to sell some units at a price that does not cover the additional costs that could have been avoided, and the company thus is making a loss, this is an indication of predatory conduct. But more on this during the lecture on abusive dominance. The tricky part is often to identify the discrete amount, which is important for two reasons. First, because we need to know the discrete amount to be able to identify all relevant costs that shall be included. And second, because we need to know with how many units we shall divide the identified relevant costs. The discrete amount will always be a case-by-case assessment. Average avoidable costs can then be calculated as the average of all the costs that could have been avoided by not producing the extra units. This calculation is illustrated in the table, and AAC amounts to 50 in this example. The second competition law cost standard is long-run average incremental costs, or LRAIC, which is also used to assess whether a dominant company under Article 102 is pricing below its costs. Long-run average incremental costs are defined in the Commission's Notice on Abuse of Dominance. Thus, LRAIC are all the incremental costs that a company incurs to produce a particular product, divided by the units produced. LRAIC includes AAC and all other costs that are specific for the particular product, and excludes common costs. And if a company is only producing one product, then LRAIC and ATC are the same. If a company is pricing above LRAIC, this will normally not be a competition law concern at all. However, many companies produce more than one product and are thus called multi-product companies. In that respect, the Commission's notice states that in situations where common costs are significant, they may have to be taken into account when assessing the ability to foreclose equally efficient competitors. As is illustrated with the house to the right, the difference between AAC and LRAIC is that LRAIC includes all the additional costs that a company incurs to produce a specific product, whereas AAC only includes those additional costs that it incurs to produce some of the units of that product. Thus, ATC covers LRAIC and a proportion of real common costs. We hope that this simple video has helped to clarify the concept of costs and how some are specific legal concepts, while others are generally accepted financial concepts. Moreover, all of these concepts are essential for understanding more complex competition law concepts to be explored in subsequent videos. As always, feel free to send questions and comments using the provided email, and thank you for listening.